Get ready, the spotlight is on Fed Chair Powell's upcoming Jackson Hole address this Friday, and anticipation is building. Traders are on edge, wondering if his speech will offer any clues about the Fed's policy moves in September. But here's where things get controversial. Most experts believe Powell won't drop any clear hints, namely because key data points, like the August jobs report and inflation metrics, CPI and PPI, haven't been released yet. Still, the tone he sets could subtly reveal how the Fed might react once those numbers come in. Wouldn't it be more enlightening if Powell discussed the Fed's independence and cautioned about the risks from ongoing government overspending? Perhaps he's saving those remarks for a more dramatic moment, maybe when he steps down. Beyond Jackson Hole, the Fed is gearing up for its once-every-5-year policy review. Remember in 2020, when the Fed introduced its new framework accepting a period of catch-up inflation to average out to its 2% target over time? That approach might now be as outdated as dial-up internet, especially since inflation surged way beyond what the Fed anticipated in the post-pandemic world. This catch-up concept should be thrown out, but what replaces it is probably just as complicated. As the U.S. government's debt burden grows, the Fed's independence might get squeezed, pushing it to work more closely with the Treasury. This could mean adopting policies like yield curve control, more quantitative easing, or even mild versions of modern monetary theory, MMT. In extreme scenarios, we might even see capital controls, a topic that sparks heated debate over central bank roles. However, don't expect these bold ideas to be part of this review. A more practical step would be scrapping the dot plot projection tool. It was designed for a very different economic era and now might only create false expectations, offering little benefit but exposing the Fed to reputational risks. On the currency front, you might be wondering why EUR USD can't break above 1.1700, or why USD JPY seems stuck with no clear direction. The truth is, the markets lack conviction right now. Repeated attempts to push the US dollar lower have faltered, mainly due to the unusually calm environment in risky assets and bond markets worldwide. This subdued volatility suggests the path of least resistance might still favor a stronger dollar, but without clear momentum, traders are waiting for a catalyst beyond just Jackson Hole buzz. The real pressure cooker lies in sovereign bond markets. Countries like Germany and the UK are seeing their long-term borrowing costs climb sharply. UK's 30-year gilt, for example, is flirting with multi-year highs. When bond yields jump, currencies often react as safe haven assets, especially when yields can't fully adjust, creating tension in these markets. Taking a closer look at USD JPY, bond yields are nudging slightly higher, but not enough to kick off a fresh rally. Interestingly, volatility in U.S. Treasury yields, measured by the MOVE Index, has dropped to levels unseen since late 2021. That period marked Fed officials Powell and Brainerd publicly acknowledging the fight against inflation, igniting a surge in interest rate volatility. Ironically, volatility is falling now, even though long-term questions about sovereign bond markets in the U.S., Japan, and the UK are becoming more urgent. The future direction of USD JPY will largely depend on policy decisions from both Japan's Ministry of Finance and Bank of Japan, as well as those from the US Fed and Treasury. Technically, after a huge reversal from a high above 150, the market has been stagnant for 12 days, weakening the strength of that move. To confirm a new trend, we'd need to see the pair decisively close above 149 or drop below 146 on a daily basis, coupled with clear policy shifts or a surge in volatility in global bond markets. Shifting over to the Reserve Bank of New Zealand, RBNZ, their rate decision tonight is highly anticipated. Most expect a 25 basis point cut to 3.00%, with the market only pricing in one more cut after that. What makes this decision so important isn't just the rate cut itself, but the forward guidance that will dictate whether the RBNZ plans to pause and evaluate or stay open to further easing if economic conditions worsen. The bank has voiced concerns about the effects of U.S. tariffs on growth, which might outweigh inflationary pressures, even if inflation shows some signs of rising. This could keep the door open for additional rate cuts if the labor market weakens further. Meanwhile, the AUD-NZD currency pair has been trapped in a narrow range for over a month. This decision might finally spark some directional movement, ending the lull. Taking a broader view across G10 currencies and the Chinese yuan, CNH, daily trading ranges have shrunk dramatically. Most of the smaller G10 currencies and the Swiss franc are experiencing extremely low volatility. This lack of weekend movement means the market is craving a fresh catalyst to reignite trading activity and drive decisive moves. For instance, EUR/SEK is testing 2-week lows and might become more exciting if the Riksbank surprises with policy action tomorrow, though expectations for a rate cut are low. Meanwhile, the Euro-Green BP pair's recent decline remains unconfirmed against its previous strength from June and July, with the possibility that it could rebound if it holds recent lows. So, what do you make of all this? Is the apparent calm before the storm masking explosive changes about to hit financial markets? Could the Fed's independence truly be at risk with monetary policy bending to government financing needs? And what about the currency markets? Are we witnessing a rare pause or just a momentary lull before major shifts? Share your thoughts and let's dive into the debate. Do you agree with this cautious outlook, or do you see signs of a different story unfolding in the days ahead?